Are you new to investing and afraid of making mistakes? It's completely normal, but here's the good news. You're not alone. Many fledgling investors share the same fears, and today, we're going to tackle them head-on. We've got a list of 9 common investment blunders that trip up beginners, and we're going to walk through each one. So buckle up, because knowledge is power, and we're about to power up your investing game. Don't worry. Everyone makes mistakes when they start investing. The key is to learn from them. Let's kick off with the first 3 common mistakes. Mistake number 1 is investing without a plan. It's like setting off on a journey without a map. You might get lucky and end up where you want to be, but chances are you'll get lost. So always have a clear investment goal and a strategy to achieve it. Mistake number 2 is not diversifying your investments. Don't put all your eggs in one basket, as the saying goes. If one investment fails, you don't want it to wipe out your entire portfolio. So spread your investments across different assets and sectors. And mistake number 3 is chasing hot stocks. It's tempting to jump on the bandwagon when a stock is soaring, but remember, what goes up can also come down. Instead of chasing trends, focus on the fundamentals of the company you're investing in. Now that we've covered the first 3 mistakes, let's move on to the next set. The next 3 mistakes are just as important to avoid. Diving into the 4th pitfall, it's crucial to understand what you're investing in. Don't just follow the crowd, do your research. Understand the basics of the company, its business model, and the industry it operates in. The 5th mistake is not considering the costs of investing. These can eat into your profits significantly. Brokerage fees, transaction costs, and fund expenses should all be considered before making an investment decision. And finally, the 6th mistake is panicking when the market drops. Remember, the stock market is a roller coaster, not a straight uphill climb. Instead of panicking and selling your stocks at a loss, see these downturns as potential buying opportunities. It's all about keeping a cool head and sticking to your investment plan. We've covered 6 common mistakes so far. Let's move on to the final 3. Last but not least, here are the final 3 common mistakes. Number 7, not rebalancing your portfolio. This is like neglecting to maintain your car and expecting it to run smoothly. Over time, your investments can drift from your original strategy, and it's crucial to adjust them back on track. This helps ensure that the level of risk you're taking aligns with your financial goals. Moving on to the 8th mistake, not taking advantage of tax benefits. Many investment accounts offer tax advantages that can significantly enhance your returns over time. It's like leaving money on the table if you don't utilize them. Finally, the 9th mistake, trying to time the market. It's a fool's game. Even experienced investors struggle to predict market movements accurately. Instead, consider a strategy of regular investing, which can help smooth out the highs and lows over time. And those are the 9 most common mistakes that beginners make when investing in the stock market. Let's recap the 9 common mistakes and how to avoid them. Firstly, avoiding due diligence and not diversifying your portfolio can lead to unnecessary risks. Secondly, timing the market, following the herd, and letting emotions drive your decisions are all recipes for disaster. Thirdly, not setting clear investment goals, ignoring transaction costs, and skipping on continuous learning can hamper your growth. Remember, it's okay to make mistakes as long as you learn from them. Happy investing!